What growth strategy combines new markets and new products? Most growth plans feel safe because they stay inside a business leader's current understanding. They add a new feature to existing customers. They add a segment for an existing offer, a geographic extension of a known model. But there is one growth move that changes both the customer and the offer at the same time. And that move creates the biggest upside and the fastest way to break momentum if the organization isn't ready to pursue it. By the end of this video, you'll know the name of the growth strategy that combines new markets and new products, why it is the highest risk growth move, and what must be true inside the business for it to work without collapsing execution. The strategy is diversification, new products plus new market. When a company introduces a new product to a new market, it's pursuing diversification. This is the far corner of a classic growth strategy model. Everything changes at once. New customers, new problems, new buying logic, new success criteria. There's no inherent advantage, no installed base, no trusted brand meaning, no proven delivery muscle. Diversification fails for a simple reason. You lose your old learning advantages. Most organizations underestimate how much their success comes from accumulated learning. They know how customers behave, where friction hides, what decisions matter, and how the pack really moves under pressure. Diversification literally wipes much of that away. Old instincts could be misleading. Old metrics confuse. Old operating rhythms no longer fit. And this is why diversification often looks strategically sound, but operationally fails. A clean example, Amazon creating AWS. Amazon Web Services is often cited as a diversification success. It was a new product for a new market with new buyers and new expectation. Retail customers did not want cloud infrastructure. Developers did. And on paper, this was a risky move far outside of Amazon's core business. So why did AWS work? They built a pack that could hold the new promise. AWS succeeded because Amazon did not treat diversification as a side project. They built a new pack, new capabilities, new operating rhythms, new reliability standards, and new customer support expectations. They did not reuse the retail pack and hope it would be stretched. They allowed the system to change so the promise could hold under pressure. That is a difference between diversification that scales and diversification that collapses. Diversification demands the find, advance, and fortify discipline. Diversification exposes weak signals quickly. Leaders must find early variance without waiting for certainty. They need to advance decisively before competitors converge, and they need to fortify relentlessly so early wins are not unraveled. Most diversification efforts stall because organizations advance without fortifying. They move fast, and then they watch execution decay. The result is initiative fatigue and a loss of confidence. The practical takeaway? Diversification is not a clever idea. It's a stress test of leadership alignment and decision speed and operational coherence, cultural resilience. If the pack cannot adapt together, diversification will expose it brutally. And this is why diversification should be treated as a capability test first and a growth strategy second. If you want to pressure test whether a diversification move is real or just aspirational, download the EdgeFinder Overview PDF. It shows how leaders identify signals that matter early, surface pack constraints before they break the momentum, and fortify the system so it holds.